There is a chasm that separates the man who comes to Wall Street for a thrill and the man who comes to make a living. It is not a chasm of intelligence, nor of luck, nor even of capital. It is a chasm of mind. The public and the professional can look at the same price on the board, the same piece of news, the same chart, and see two entirely different worlds. One sees a lottery ticket. The other sees a mathematical problem of probabilities. Until you understand these differences, not merely in theory but in the very fiber of your being, you will remain on the wrong side of that chasm, endlessly funding the accounts of those who do. The market is a machine designed to transfer wealth from the hopeful to the disciplined. Your job is to decide which you will be. The first and most fundamental difference lies in the fuel that powers your decisions. The public operates on a volatile mixture of hope and opinion. The professional runs on the clean, cold-burning fuel of fact. When I began my career, I did so not in a grand brokerage house, but in what were known as bucket shops. These were establishments that were, in essence, fraudulent brokerages that never actually bought or sold stock on an exchange. They simply took the other side of a customer's bet. If you bet a stock would go up, and it did, they paid you from their own till. If it went down, they kept your margin. It was a pure, unadulterated bet on price direction. In that environment, there was no room for hope. There were no annual reports to read, no insiders to listen to. There was only the ticker tape, that endless ribbon of paper that printed the price and the volume of each trade. It was the ancestor of your modern real-time charts, the raw, unfiltered voice of the market itself. I did not know the names of the stocks. I did not care what they manufactured or who sat on their board of directors. All I knew were the symbols and the patterns they made on the tape. I learned to read the behavior of prices. Was the advance gaining momentum? Was the selling on a decline drying up? These were not opinions. These were facts, reported live from the battlefield of supply and demand. My system was built on observing these facts and making my play based on the probabilities they suggested. It was a statistical and observational business, not a hopeful one. The public, then as now, would come in with a tip from a friend, a belief that a certain company was destined for greatness, a hope that their luck would turn. They were betting on a story. I was betting on mathematics. The difference in our results was staggering. All of this is chronicled in the book they wrote about my life, Reminiscences of a Stock Operator. You would be wise to study it, not as a history book, but as a manual of war. The link is in the description of this video, and it contains every mistake you are about to make. Years later, after I had made my first million, I had the misfortune of confirming this lesson at great cost. I befriended a man, a brilliant and successful speculator named Percy Thomas. He was older, more experienced, and I looked up to him. He was heavily long Union Pacific and was utterly convinced of its merits. The stock began to turn against him, but his conviction, his opinion, did not waver. The tape was telling a clear story of distribution, of smart money unloading their shares. But he saw only his own belief reflected back at him. He convinced me to ignore the facts my own eyes were seeing on the tape and to trust in his hope. He hoped it would turn around. He believed it must. He substituted his wishes for the market's reality. I listened, and it cost me almost everything I had. He, a man who had made millions, was completely wiped out. He could not separate his ego from his position. The market was telling him he was wrong, but his pride would not let him listen. He was trading on the most dangerous drug in this business, hope. The public does this every single day. They buy a stock and immediately it becomes their favorite child. They look only for news that confirms their purchase. They explain away any price drop as manipulation or a buying opportunity. They are no longer observing the market. They are cheering for a team. The professional has no team. He is a mercenary, loyal only to the direction of the trend. He feels no affection for a stock that is making him money, and no animosity for one that is costing him money. It is simply a number on a ledger. This is the first law you must burn into your mind. You are not an analyst. You are not a storyteller. You are not a fortune teller. You are a tape reader. Your job is to decipher the facts as they are presented by price and volume and to align yourself with the path of least resistance. Banish the words, I think, I feel, and I hope from your trading vocabulary. Replace them with the tape shows. Do not argue with the tape. Do not project your desires onto it. Listen to what it is telling you, not what you wish it would say. If you cannot do this, if you insist on trading your own opinions, then you are not a speculator. You are a gambler, and the house always has the final say. The second great divide between the public and the professional is how they view a loss. For the amateur, a loss is a personal failure. It is an indictment of their intelligence, a direct blow to their ego. They feel the market has personally attacked them. Their reaction is to freeze, to deny, to hope, and ultimately to hold on even tighter, as if stubbornness could reverse the trend. For the professional, a loss is nothing more than a calculated business expense. It is the cost of gathering information. It is as mundane and unemotional as a shopkeeper paying his rent. He knows that he will be wrong a certain percentage of the time and has built that fact into the very foundation of his business model. When I place a trade, I do so based on a hypothesis derived from the action of the tape. If I buy a stock at a pivot point, my hypothesis is that the line of least resistance is now upward. If the stock, instead of advancing, hesitates and then declines, the tape is providing me with new information. It is telling me my hypothesis was incorrect, or at least premature. The trade is not working as anticipated. To hold that position now would be to switch from my initial, fact-based reason for entering to a new and deadly reason for staying in. Hope. Hope that I might get back to even. This is the amateur's trap. The professional acts on the new information immediately. The loss is accepted. The position is closed. The capital is preserved for the next opportunity, where the facts are once again in his favor. The ego is never consulted. I learned this through the painful process of ruin. I lost my entire fortune on more than one occasion. And every single time, without exception, the catastrophe was not the result of one bad trade, but of one bad trade that I allowed to become a disaster. It was always because I broke my own rules. I held on to a losing position, violating my stop-loss, believing my original analysis had to be right. I let the loss become personal. I argued with the tape, and the tape always wins. It was from the ashes of those failures that I forged my most important rule. Never suffer more than a 10% loss on your capital for any single speculation. This was not a suggestion. It was an unbreakable law. This rule was not just about limiting financial damage. It was a mechanism to automatically protect me from my own human nature, from my own ego, my own hope, my own stubbornness. It forced me to treat trading as a business of risk management, not a game of being right. The public cannot do this. They buy a stock at 100. It drops to 90. They see a 10-point loss. A professional sees a stock that has failed to act as it should have and is now on the wrong side of the ledger. The public says, I won't sell until I get my money back. They have now turned a speculation into an involuntary long-term investment with no plan other than the wish to break even. This is financial quicksand. They refuse to take the small, manageable loss and instead virtually guarantee they will eventually take a much larger, more destructive one. They think of the loss only after it has grown large and fearsome. The professional thinks of the loss before he even enters the trade. He knows his exit point before he knows his profit target. The public focuses on how much they can make. The professional focuses on how much he can lose. This is the key to longevity. The man who is afraid of taking a small loss will inevitably be forced to take a catastrophic one. He saves pennies at the cost of dollars. He wins many small battles and then loses the entire war in a single afternoon. Here is your second law. Your first loss is your best loss. Treat it not as a defeat, but as a tuition payment for an education in the market. A small loss is a strategic retreat, preserving your army to fight again. A large loss is a rout from which you may never recover. You must define your maximum acceptable loss before you ever click the button to buy or sell. This is your business insurance. And when that price is hit, you must act as automatically and unemotionally as a circuit breaker in a powerhouse. Do not think. Do not hesitate. Do not hope. Just act. Sell the position. Preserve your capital. Your job is not to be right on every trade. Your job is to survive and be profitable over the long run. Survival is achieved by ruthlessly cutting off losing trades before they can metastasize. The third, and perhaps most subtle distinction, is the perception and use of time. The amateur believes that to make money one must be constantly active. He feels the urge to be in the market at all times, chasing every small wiggle, every minor fluctuation. He suffers from a fear of missing out on a move, any move. He equates activity with progress. The professional knows that the vast majority of the time, the correct course of action is to do absolutely nothing. He understands that money is not made in the buying or the selling, but in the sitting. In my early years, I was like every other inexperienced speculator. I wanted to trade every day. I felt I was wasting my talent if I was not in a position. I would scalp for small profits, a point here, a point and a half there, and I made a living. But I never made the big money. The big money came only after I learned the virtue of patience. I could correctly diagnose a bull market and buy a stock at the right time, only to sell it for a paltry profit when it had a normal, healthy reaction. Then I would watch, helpless, as it resumed its advance and went on to make a truly life-altering move without me. My diagnosis was correct, but my impatience cost me the fortune that should have been mine. It was a difficult lesson to learn, that my brain could be right, but my twitchy fingers could make me wrong. I remember watching an old man at one of my brokerage firms. We all called him Old Turkey. He was the subject of much amusement for the younger, more active traders. We would see him in the customer's room day after day and ask for his opinion. He would peer over his spectacles and invariably say, "Well, it's a bull market, you know." He bought stocks and he never seemed to sell them. We, in our youthful arrogance, would jump in and out, scalping our little profits, feeling very clever. We would tell him he should take his 10 points in steel and buy it back on a dip. He would just smile and shake his head. In the end, we had our small scalping profits, and the broker had most of that in commissions. Old Turkey had the big money. He understood that the real profits were in capturing the great swings, the major trends. And the only way to do that was to have the courage and the patience to sit tight. It was never my thinking that made the big money for me. It was always my sitting. The professional does not trade for the thrill of action. He trades for profit. He understands that the market is not a continuous stream of opportunities. It is a landscape of long periods of confusion and chaos, punctuated by brief, clear moments of opportunity. The professional's job is to sit patiently in cash, preserving his capital and his mental clarity through the long, chaotic periods. He is a sniper, not a machine gunner. He waits for days, weeks, even months, for that one moment when the line of least resistance is clear, when the odds are stacked overwhelmingly in his favor. This is what I call the pivot point, that critical price level where a stock, after a period of consolidation, is ready to make its next major move. To trade before that point is to gamble. To trade at that point is to engage in intelligent speculation. The public cannot bear the waiting. Boredom is their enemy. They will jump into a choppy sideways market and get ground to pieces, whipsawed back and forth. They provide the liquidity and pay the commissions that feed the brokerage houses while the professional sits calmly aside waiting for the easy money. This is your third and final law. Cash is a position, and often it is the wisest one. You're not paid for the frequency of your trades, you are paid for their accuracy and magnitude. Cultivate the iron discipline to sit on your hands and do nothing until you see a setup that is so clear and compelling that the trade becomes almost automatic. Learn to love the boredom that comes with waiting for the perfect pitch. The market will always be there tomorrow, but your capital may not be if you waste it on low-probability guesses today. Let the amateurs chase the small, meaningless ripples. Your task is to wait for the great tide of the major trend, and then to have the courage to ride it until the turn. The greatest fortunes are not made by nimble feet, but by a patient backside. Master these three distinctions, and you will not only survive, you will conquer. Fail to learn them, and Wall Street will find your account, and it will empty it. The choice is yours.